To welcome everyone to today's webcast. I'm Sylvie Godant, a partner at Citron Cooperman, and I lead the transaction advisory practice. We are a full-service accounting, tax, and advisory firm with over 1,200 professionals nationwide. Since 2017, our firm has issued an annual report on the independent sponsor sector, and this year we decided to devote our entire report on the impact of the pandemic, not just on independent sponsors, but also on their portfolio companies, their investment strategies, deal structures, and valuation. The survey was conducted in May of 2020 and reflected the views of 112 independent sponsors. We believe that the independent sponsor perspective is particularly relevant to understanding what is happening right now in the lower middle market, which, we're in the middle of unprecedented times. And we're going to talk about it later, but lower middle market, when we talk about lower middle market, we're talking about companies with less than $250 million in revenue. So why is the independent sponsor perspective, relevant to today's market? It's because independent sponsors tend to acquire, own, operate, grow, and eventually divest small and mid-sized businesses. And those are the businesses that make up the vast majority of the US economy. So we have already issued a series of key findings from our 2020 survey, most of which were discussed during our last webcast on July 1st. If you didn't get a chance to attend, the recording has been posted on our website. We also plan to release a comprehensive white paper next month. So today's webcast will be dedicated to one topic, and it's valuation. And as you know, it's a topic that's already challenging in itself. And now we're in the middle of a global pandemic and one of the worst public health and economic crises in US history. So question is, how do you value a business in today's environment? It's obviously not a black and white answer. There are various shades of grays, and we're going to dive into those today. So I invited 3 seasoned deal makers, including 2 independent sponsors, and the head of our valuation practice, to provide you with actionable guidance and practical insight. So let's get started. We're going to do panel introductions. And Richard, would you like to start?
Sure. Thanks, Sylvie, and thanks for having me. My name is Richard Baum, and I am one of the co-founders and the managing partner of an independent sponsor called Consumer Growth Partners. We were founded in 2005. We focus exclusively on investments in retail and non-perishable branded consumer products companies, probably 2 of the worst sectors that have been hit by COVID, which I will discuss through the course of the webinar. We do focus on the lower middle market. We also have an advisory practice where we work with companies typically in the lower middle market before they are ready, willing, or able to take in outside equity capital.
Bruce, do you want to do your introduction?
My name is Bruce Lippian. I'm a co-founder of Stone Creek Capital. My partner and I have been together for over 20 years, and we focus primarily on management buyout-oriented investment opportunities in the $10 to $50 million transaction size. Our focus as an independent sponsor is fairly agnostic and really is about finding opportunities where we can team up with executives who have an opportunity to buy a business, but they don't have the financial experience of doing a deal or access to capital in the way that we do. Both Richard and I were definitely gray hairs among the independent sponsor community. We've been doing this since the movement started in the mid-2000s, and it's pretty amazing to see how well accepted the independent sponsor has become as it relates to a credible and viable approach to doing private equity investing.
Gretchen, would you like to do your introduction?
Thank you, Sylvie and Mandeep. I've worked with both Sylvie and Mandeep at Citron, and I'm very grateful for Citron Cooperman's focus on the independent sponsor market. It's definitely been helpful in elevating that sector, and we do many deals, independent sponsor deals, and my gray hair you can't see, not because of the video, because I cover it up, but I have also been looking at deals with Richard and Bruce for years and years, and feel like I was one of the few, Huron was one of the few capital firms specifically targeting and marketing to independent sponsors, and good for the independent sponsors. And unfortunately for us, there's now lots of private equity firms who focus on independent sponsors as a great source for deal flow and creating shareholder return. So with that said, I'm with Huron Capital Partners. We're a lower middle market private equity firm focused on consumer, business services, and specialty industrial businesses with EBITDA from 5 to 25 million. We celebrated our 20th anniversary last year. We have multiple independent sponsor deals in our portfolio, both in our flagship buyout fund and also our newer strategy, which is our flex fund, a non-control preferred equity strategy to support independent sponsors in the deals that they're closing.
I'm Mandeep Trivedi, and I lead the firm's valuation practice. And my perspective is slightly different from the other panelists in the sense that I am usually called upon to kind of give a baseline value of what a business might be worth. And then obviously the deal negotiations happen, and sometimes the price could be different than what we would say value. I think over the last few years, what we've seen is value and price are not necessarily the same thing. I think what COVID has done is just really woken many businesses up and many investors up to that disparity. And so I'll be commenting purely from a valuation perspective in terms of what COVID and the impact COVID has had on values of businesses overall.
Great, thanks, Mandeep. So we do plan on answering a lot of questions today, but just in case, there's a question that pops up, please use the Q&A chat box to answer all of your questions. And what we plan to do is address them live at the end of the webcast. And if we do, can address all of them, we'll reach out to you directly after the webcast. But, feel free to, again, answer any questions in the Q&A. So let's get started. So, we want to set the stage and really talk about the current M&A environment. And Richard, so what deals are getting done now and what deals are not getting done?
Obviously, when COVID really hit, kind of in the March, April timeframe, for the most part, there were very few, if any, deals getting done. And that's because many companies were just trying to figure out how to stay alive and preoccupied with trying to get money from the government programs like the PPP, drawing down all of their ABL lines to get cash, and really focusing heavily on managing their expenses as well as their working capital, because everybody was in a really cash conservation mode. Things probably started to open up kind of in the May, June timeframe, a little more. And so deals were starting to get done. I will say very few in my sector. I think there's three types of deals that were getting done. Flip side of that, the deals that weren't getting done or are not getting done really tend to be the mirror image. So the first type of deal that seems to be getting done is one where the business was more or less unaffected by COVID, or the company was an actual beneficiary of COVID. These would be companies that are selling essential products like masks and respirators. Supermarkets, for example, selling food, gas stations, and any companies providing essential services that are in the healthcare or medical device segment. That's probably where the bulk of, and certainly we saw some of those deals as well, but that's probably where the bulk of them were getting done. Secondly, businesses that either were primarily or exclusively online businesses. So these would be businesses that were the least dependent on crowds. Crowds have had and the potential for crowds has obviously had a huge negative impact. But if you had a business that really wasn't dependent on crowds, and nothing could be farther from a crowd than sitting in the comfort of your own home in front of your computer and buying things. And then third were add-ons. And these are add-ons where the strategic fit may be more important than the profitability of the company, because at least with independent sponsors, for sure, we always have a bit of a difficult time with businesses that are losing money. But for companies that have a build and buy strategy, add-ons have become a very, very attractive source of deals. On the flip side, deals that are not getting done, again, businesses that were severely affected by COVID, hospitality, retail, restaurants, gyms, all went through a period of revenue essentially going to zero. And this occurred in the March, April, May timeframe. There's been some reopening under somewhat strict guidelines, but it's been on a state-by-state basis, so it's very sporadic. Secondly, businesses that are crowd-dependent, sporting events, concerts, theater, conferences, trade shows have all gone to zero. We've seen what's happened in the world of professional sports, and also businesses that support them. So caterers, event halls, and people who are supplying large crowd events. And then lastly, businesses that are deals that are not getting done tend to be platform businesses that are losing money and don't have adequate cash or equivalents to get through the next, call it 6 to 12 months. As I said, we've always had trouble with businesses losing money, and with add-ons, it's not so bad, but with platform businesses, it's probably very difficult.
Thank you, Richard. That was very informative. Bruce, would you like to add anything?
Yes. Looking at it from I agree with everything that Richard said, but looking at it from a little bit different perspective, what we're seeing is it starts with a threshold decision rather than a valuation decision, because there's so much uncertainty and volatility in the business. What I would say is, as it relates to getting a private equity group to even consider looking at a business, that business needs to have demonstrated cyclical resiliency and pandemic resiliency. I think until the latest crisis occurred, pandemic risk was not reflected in anybody's underwriting criteria. And now it's paramount. And then, being out in the market, there's another element of risk that can really affect a private equity group's willingness to invest, and that's dependency upon China for product supply. There's a lot of concern that both a combination of the pandemic issues coupled with the global political situation makes that an awfully large risk if a business is dependent upon sourcing supply. So I thought I would just refer to one segment that is both pandemic resilient, cyclically resilient, and doesn't depend upon China for product supply, and that's the defense sector. But in the defense sector, that's got its own risks, particularly the risk of political administration. So I think the way that plays out in that particular segment is that there's more of a willingness to consider investing in the segment, but there's also, I think, some level of discounted multiple because of the uncertainty.
Thank you. Gretchen, do you want to add anything to what Richard and Bruce have said?
Yeah, the only thing I would add is that certainly deals that have done fine in the COVID time, those can get done now. And frankly, they can get done at a premium because they have proven to be a safe port in the storm. And there is a dearth of new platform deal opportunities. So if anyone has a holding that has been pretty steady Eddie in COVID, doesn't even have to be doing better, but just doing steady Eddie, those deals are getting done. And as I said, at a premium. I don't think I have anything else to add. I think Bruce added the element of a downturn, a recession, and that for sure, that, any deal we underwrote pre-COVID, we're in year 10 of an expansion or maybe 11, depending upon how you count it. And
right.
We always are modeling, what happens to this business in a downturn. So that's just this, along with, I saw a deal from an investment bank yesterday that was manufacturer of parts used by an OEM in a particular industry, but very, not a lot of concentration. It was very broad-based industrial. And they had very intricate add backs and projections for this year and the COVID impact on both top line and cash flow. And then 2021 projections assume basically back to pre-COVID volumes. And I just responded that I think that's a pretty big assumption. And that, as Bruce said, there will be a cyclical downturn at some point. Maybe it's when the bonus unemployment checks run out. Maybe it's after, a lot of companies are on life support due to the government assistance. And when that runs out, well, then the pressure starts getting applied in terms of lenders and, lack of liquidity. And so, yeah, that's a very few, intersection and a Venn diagram of things that are unaffected by COVID and won't be unaffected by a downturn.
Thank you. All great points. We talk about, and Gretchen, you mentioned some businesses are maybe getting acquired at a premium now, but we actually asked our independent sponsor respondents about, it was an open-ended question about the impact of the pandemic on valuation multiples and on valuation just broadly. And interestingly, what many said is that, they expected EBITDA multiple to go down by, 1 to 2 turns. Before I go to Mandeep to address this point, I just want to give you a little more background on independent sponsor transactions. So independent sponsors, just like I said at the beginning of the program, tend to acquire small to mid-sized businesses. And based on our 2019 independent sponsor reports, just want to give you, size. So 54% of independent sponsors that responded to our last survey tended to target companies with $2 to $5 million of EBITDA. 28% targeted companies with $5 to $10 million of EBITDA. And then about 14% looked at smaller companies with less than $2 million of EBITDA. So overall, we're in the, less than $10 million of EBITDA. And these independent sponsors tend to buy companies, with, 68% said, 4 to 6 times. So the EBITDA multiples were 4 to 6 times. And then 22% said it was 6 to 8 times. So just to give you in a sense, kind of a, starting point, we're talking about it 4 to 8 times, and the drop is, 10 to 20%. So having said all of that, I'd love to, Mandeep, to give your perspective as a, valuation expert on this panel.
Thanks, Sylvie. So if you think about that range of multiples, right, 4 to 8 times, in theory, when someone's making an investment and they're willing to pay for, let's say, 4 times, the expectation is if EBITDA remains at the level that they anticipate it to be, they'll get their money back in theory in 4 years. So now we're in an environment where there is so much uncertainty and businesses are dealing with something that overnight they've had to kind of react to. And the question becomes, how quickly do you want to get your investment back? So are you going to be willing to pay 8 times on the higher end of the range for something that is less certain than if you pay a lower multiple now, but with a little bit more certainty? So I would say I found that the respondents' comment of a 1 to 2 times decline in multiples to be really interesting, because I don't think it's accurate to say that that would be true across all industries and all sectors. You've already heard from the other panelists that there are certain areas and certain businesses that are actually benefiting from the pandemic to a certain degree. I think what we're seeing is going to be more of a pause from buyers and a rethinking of the way that they look at the deals, a rethinking of the way, what they're willing to pay and how the deal is going to be structured. And I think deal structure is going to be probably, I'm going to guess, a little bit of a theme today, because from a valuation perspective, a buyer is going to be asking, how did this business fare in the COVID environment, right? How permanent were the effects of COVID on the business? And if the business was negatively impacted, will there be a recovery in the business's operations post-pandemic? And what is that recovery going to look like? And when will that happen? So going back to Gretchen's point of getting projections from a business and they're back to pre-COVID operations, in a short period of time, how realistic is that? And if the impact is more permanent, I think you're definitely going to see a downward adjustment on the multiples. Those businesses that are less affected are probably going to command a higher multiple, maybe not necessarily pre-COVID multiples in some cases, it may, but it's those businesses that have not fared well or are unlikely to rebound with any level of certainty that are really going to see that decline in multiples. I think if you think about valuation and what the valuation exercise is we're essentially trying to predict the future. And there's really three approaches to value in theory: the cost approach, the market approach, and the income approach. Now, the cost approach isn't necessarily relevant unless you're really dealing with a business in liquidation. But the other two approaches are where this concept of the EBITDA multiple comes from, right? You have the earnings, the EBITDA, the expected cash flow of the business that hopefully a buyer is hoping to extract in the future, and they're willing to pay some multiple of that today. So that's really the income approach, the hope and the expectation of what the business is going to generate. On the flip side of it, you have this concept of the multiple, right? What are market participants willing to pay? When you're in an environment where you have very little activity in the COVID environment, there's no real benchmarks to say what that EBITDA multiple should look like, because there isn't enough transactions to compare the business or the target to other businesses that have been sold in the COVID environment. So I think what's really going to be important is these future forecasts, more so than in the past. I think everyone always looks at a discounted cash flow model because they want to know what the business's capabilities are, but it always comes back to a multiple in this space. But I think that future cash flows are going to be pretty critical. Whether the decline in multiples is long-term or short-term, that's really going to depend on a multitude of factors. Obviously, where the economy is, how the business operates in different economic cycles, what's going to happen with COVID? Is there going to be a resurgence? Is this going to drag out for 6 months, a year? It's really hard to say, but it's all really going to depend on how the businesses fare in this environment, to see which end of the spectrum they're going to be able to command a multiple. I think there is still a lot of money out there. The question is, where will that money be deployed? And it's probably going to be deployed in businesses that have the ability to withstand some of the impact that a pandemic like COVID has brought to the forefront of how businesses operate.
Thanks, Mandeep. I could not agree more when you think about the past 10 years. And Gretchen mentioned it earlier. We were in a seller's market, and there was a really large amount of capital available to do transactions. So I like the fact that you're saying today's private equity investors and others are taking a pause, dealing with the situation and assessing how they're going to value those companies going forward. Love to hear from Richard, Bruce, and Gretchen on that topic. I don't know, Richard, do you want to get started?
Yeah. Sure. So just to hark back to what Mandeep just said, and also Gretchen's example of the deal that she got, I think that the tough part is not going to be the multiple, the tougher part. It's going to be what the EBITDA is. And we've got, I think the next couple of questions kind of go into more detail on that, Sylvie, but
right.
You got to you got to multiply, you got to put the multiple on some number.
Right.
And
is it a lower number?
At this point, trying to figure out what that number is, is mind-boggling. I don't know that anybody has come up with, there are no good, there's no good formulas at this point. There's some thrown around. We'll talk about them. But just the sheer difficulty of trying to, and even get agreement between the buyer and the seller on, this is the EBITDA number that we're going to use, is going to be a very, it's an enormous exercise and probably keep Mandeep busy for the next 50 years.
That's for sure. Bruce, did you want to add something?
Yeah, I definitely agree that just in general, we're going to see a 1 to 2x decline in multiple, especially given the, we're really focused on the micro end of the middle market. And it's already challenging to be able to get higher levels of debt for businesses that are under 5 million EBITDA, and the ability to get that type of financing now that we've got, the pandemic among us, I think is that much more challenging. And the reason I'm focusing on that is I think aside from the risk factor, just the availability of debt has an impact on what the multiple is going to be. Having said that, I think that Gretchen commented on the fact that, businesses where you can check the box and they've demonstrated resilience during the pandemic can actually be, you can get a premium multiple. The reason we don't see as many of those is because the universe of those opportunities is relatively small. But one of the things that I find very encouraging for the independent sponsor is the fact that the institutional private equity market, those funds are all based on 5-year commitments from their LPs. And depending upon where a particular group is, how long they have access to those funds and the likelihood that they can raise another fund is going to make groups that need to deploy capital actively look for opportunities to deploy that capital. Because if they don't deploy it and the investor commitment expires, they don't get the benefit of the upside. So I think, within the independent sponsor community, we have the ability, if we can find those opportunities, to get them funded because there's less supply as it relates to good investments.
Great point. And Gretchen, do you want to add anything to this?
Yeah, Bruce is completely correct. We have a mandate to deploy capital in order to create returns for our investors. Those investors being pension funds, college endowments, and nonprofit organizations for the most part, for not just Huron, but the entire private equity industry. That's the primary asset classes of those who invest in traditional private equity funds. So yes, there is a use it or lose it element that that will make a deal that an independent sponsor can bring us outside the normal investment banker circles very exciting, and you'll get a lot of interest. And I would just, my comment on this question in terms of what the respondent stated, yes, multiples have gone down 1 to 2 times, unless it's one of these COVID outperformers or COVID sustainable deals. And that's because of how much the leverage markets have gone down. Mm-hmm. And leverage, what the lenders, senior lenders, and junior lenders are willing to provide very much drives valuation. So, when you see pre-COVID, that most lenders are willing to go up to tolerate 5 times total debt on maybe a bigger deal than a $5 million EBITDA deal. That's probably for the market over 10. But we know as a buyer, then that means the base price of that business is 10 times. Now, if the bank said, oh, we're only going to do 4 times, well, then the base price of that business is going to be 8 times, and probably something above that, in a normal world. So, yes, I agree that multiples are down, and it is because of the debt markets. And when the debt markets return and increase, then valuations will track with that.
Mm-hmm. Great point. So, we are talking about multiples. Let's talk about the numbers that you apply multiple to. So, we also had an open-ended question to our independent sponsor respondents about, what approach would be used to value a business now and post-COVID. How do you deal with that COVID period, right? So there's several answers that came up multiple times, and we listed them in our top 10 key findings, but also here. So couple of things. So, and some of them make sense. It's adding back or deducting specific COVID adjustments. The other one is taking an average of multiple years, and I guess if that makes sense in some situations. Mandy talked about this, is looking at forecasted revenue and earnings. And then, others said that they may use the 2019 results with a lower multiple. So Mandeep, do you want to add anything on these approaches?
Sure. So, that first concept, it's fascinating to me. Earnings before interest, taxes, depreciation, amortization, and coronavirus. Of all the events, the tech bubble, the Great Recession, this is the first time that I've seen a regular use of a new EBITDA acronym.
Right.
And the question is it such a unique event that it may never be replicated, right? And the reason I say that is if you think about the typical EBITDA adjustments that are made when you're doing a deal, when you're coming up with that holy grail of adjusted EBITDA, you're making adjustments to the historical earnings of the business for things that are non-recurring in nature, right? It could be a litigation, it could be losses related to some type of business disruption that's not, in the owner's control, like a flood or a fire or something like that. You make adjustments for market rate adjustments. So you make adjustments to reflect things like family members on the payroll or compensation for related parties that may not be at what we call market level, right? Or, for owner's compensation that may be below or above market. You adjust that to get to the adjusted EBITDA. You adjust things for maybe related party rent. And then you adjust for things like perks, the perks that the owners have been taking, whether it's cars, country club memberships, or travel and vacations. And the purpose of that is to really reflect what the business is capable of generating annually or on a regular and consistent basis in somebody else's hands. So the question is if the COVID impact truly is temporary, I think it's a fair exercise to add back the impact of COVID to the business to reflect its true value. However, if the impact is going to have more permanent effect on the business, I'm not really sure it's appropriate to add back all the effects to revenue and income. So what is the answer? I don't think there really is a clear answer, to be honest with you. I think you have to look at each business in its own unique capability to deal with the pandemic. So, using an average of multiple years might be reasonable if your goal is to predict the future. You have to figure out which years are going to possibly reflect what that future looks like. And if none of the recent years are reflective of what the business is going to be capable post-COVID, it may not make sense to look at an average number of years. If you're using the 2019 results, which was one of the suggestions with the lower multiple, that also might be a reasonable exercise to undertake if 2019 is going to be reflective of the future and 2020 was just a temporary adjustment as a result of COVID. But maybe what you do is you have 2019 with a lower multiple with some type of kicker for performance, or I go back to what I mentioned earlier, whereas I think there's going to be a lot more creative deal structuring to try and capture the impact that COVID has had on the business in the short term, and also not to injure the owners of the business who have built up a business that is sustainable in post a pandemic. But I go back to what I was saying before. I think looking at forecasts and really scrutinizing the discounted cash flow models is going to be something that you're going to see at unprecedented levels. There's going to be a lot of pushback on what management's expectations of the future look like. And I think those businesses that can tell and articulate the story of how they dealt with COVID and the pandemic and how they're dealing with it and how they intend to get to the other side of it are really going to be the businesses that are going to command a higher price in the long run.
Thank you. Bruce, do you want to add anything to what Mandeep said?
Yeah, first of all, I really, Mandeep thought that was a really good review of the approaches and made pretty clear, who knows? This is really, really tricky on so many different levels. First of all, when we talk about valuation, valuation is an analytical exercise, but in a deal situation, you've got three different constituencies who have to mutually agree on what the adjusted EBITDA is. Seller wants to see the most adjustments that they can get. And just, I know for our firm, I think for an awful lot of others, the more adjustments that a seller tries to throw on the heap and get a higher adjusted EBITDA figure, the more potential for contention there is in the negotiations. So what's reasonable from a seller's point of view? You've got your lender who you're going to ask to lend a multiple of EBITDA. And they're going to have much more stringent standards simply because they're, in the business of minimizing their risk. And then, of course, you've got the buyer who wants to make sure they're not overpaying for the business. And so I think for me, the single most important factor is how is the company operating prior to the pandemic? And what's the likelihood that business is going to recover to either where they were or on the trend line? And then, quite frankly, I don't use this word in pejorative sense, but this is an art as it relates to being able to articulate the essence of how a business is affected and then get the various parties to buy into the reasonableness of the adjustments that you're making. And I think the less subjectivity there is and the more you can quantify, the more success you're going to have in terms of coming to a valuation that enables you to get a deal done.
Thanks, Bruce.
I couldn't agree more.
Yeah, thanks, Bruce. Gretchen, do you want to talk about maybe the lender's perspective? And there's actually a question about what are you seeing from lenders in terms of their willingness to make COVID-related adjustments for existing portfolio companies or new transactions?
Yeah, well, it's hard to add to the great commentary and comprehensive commentary that Bruce and Mandeep outlined. I will touch on one thing before I answer that question, the revenue question, the lender question. I have seen some very unique structures where a private equity firm had something negotiated with a business owner pre-COVID. COVID happens, everybody puts their pencils down for 3-4 months, and the business owner still wants to go through with the transaction, realizing there's going to be some, structure adjustment and maybe price. And I've seen a couple of examples where the buyer has purchased the business at a lower multiple based on 2019 unadjusted performance. This is what it is. But they've constructed 6 months, every 6 months for a period of 2 years or maybe 3 years, really depends. And to Bruce's point, all of this is subjective and negotiated. But they have set up certain trigger points into the future where the EBITDA will be measured again, and they've set up an escalating grid or, matrix, I guess, of, if you get to this point, we will forward you X more enterprise value. If you get up to here, so the point being at the end of 2 years, the business is back at, kind of full strength at where everyone thought it was going to be. The original valuation multiple will be honored and the private equity firm, the buyer, will true it up with the business owner. Now that is very unique and very safe for the private equity firm. Gets the business owner a sizable liquidity event now, not as big as it can be, but that relies on the business owner being very confident that his or her business can indeed get back. And that's great. They're putting their money where their mouth is, and they're willing to delay getting full valuation, which I think is a very reasonable approach in today's market. Otherwise, you can just take your company off market. You'll get zero in this market in terms of what you wanted versus before. Lenders, Bruce brought this up. Yes, lenders are a huge impact on what valuation is. There's a big difference between lenders right now. The two populations of lenders you have are banks proper, those that are backed by the strength of the U.S. Treasury and the U.S. government. And then there's the non-bank credit funds, which have exploded in growth. And that's because the investors that I mentioned before, pension funds, college endowments, nonprofits, there's a huge appetite for current income for these guys. And so they invest in debt funds because they get regular interest payments. And so that's a great balance with their portfolio of other investments that are longer hold that really don't provide ongoing cash flow. It's more of a lumpy cash flow upon exit. So there has been a giant amount of capital in those sectors. All lenders were really taxed in March when we were all pulling down on our revolvers, right, to get liquidity and lock it in. For the most part, throughout the industry, U.S. banks, no problem with that. You know, if your loan agreement allowed you to draw down the revolver under certain scenarios. And in early March, you know, people's businesses' performance wasn't hugely negatively impacted. And so banks had no reason to deny a revolver draw, and we all drew down to whatever extent we could. Non-bank lenders, not backed by the strength of the U.S. government, had more trouble. They had to, you know, they generally had to go back to whomever their main funding source is, whether it's an insurance company or a sovereign wealth fund or whatever, and get a capital injection to be able to meet all of the liquidity draws. And so some of those credit funds have done that well, some have not. And depending upon how that lender is now capitalized will impact their ability to do new deals or their appetite. I think the U.S. banks, you know, most of the private equity industry started using the private debt funds because they would give more leverage and add, you know, better terms and pricing. And it's just interesting how the pendulum is swinging back now, where having a U.S. bank on your balance sheet is actually there's some real positives to it, even if it maybe wasn't the cheapest and the highest leverage. So that'll be interesting to see how that evolves going forward. But that would be my only commentary, that, you know, the type of debt on your balance sheet or the type of debt that you're going for will be impacted by whether they're in one camp or the other.
Great. So, Richard, we have maybe a minute left on this topic. Do you have something you'd like to add?
Yeah, I think I can give you a 1 minute. So I thought that Mandeep's description of all of the different methodologies for coming up with the right EBITDA are certainly appropriate. And I think this is going to become more of a triangulation exercise than any single point analysis. You know, there's certain validity to each of these, and I think that they will be used in combination. And, you know, hopefully out of the alphabet soup, you get some sort of, you know, let's say meeting of the minds at a number that, you know, seems, when you look at all four of these measures, or maybe something else, you know, seems to be a number that all three groups, as Bruce so aptly described, can agree on.
All right, great. Thank you. All right, let's move on to, and then, you know, we covered some of that. Let me switch to the next slide. Okay, I wanted to drill down a bit on COVID adjustments, and we, you know, spoke about it a bit. And I know somebody asked in the Q&A section, do you have negative add-backs for overperformance? And you know, that would be correct. It's, you know, it's really plus or minus. So maybe we can talk about more specific examples of how we would evaluate and adjust for the impact of COVID-19 on revenue, earnings, and also working capital, plus or minus. Bruce, do you want to get us started?
Sure. So, I mean, all of these responses really depend upon, you know, whether demand has increased or decreased for particular companies' goods and services, and how pronounced that increase or decrease is. And for businesses that we've talked about that are tied to crowd gathering, you know, sporting events, trade show conventions, movie theaters, where new revenues, you know, have fallen off a cliff, though many of those businesses, quite frankly, aren't focusing on, you know, the equity appreciation or equity, but equity preservation. Because at the moment, those businesses are focused on being able to keep their doors open through however long the runway, however long it takes to get to the other side. And, some businesses, I think, let's just use movie theaters as an example. When the movie theaters reopen, I think you're going to see it bounce back pretty quickly because people are excited about going to the movies. There's pent up demand and they don't have to hop on an airplane. But in, trade show conventions, who knows how long it's going to be before the people are comfortable gathering in those types of environments and hopping on an airplane and the like. So for the businesses where they're really struggling just to keep their doors open, I think it's way more a focus as a private equity investor on making sure that our businesses under those circumstances that were doing great before the pandemic have an opportunity to rebound on the other side. And that raises some really interesting questions or scenarios as it relates to what do you do to preserve the equity value. And one of the things is that for those businesses that don't have revenues rebounding, they haven't had the benefit of recovery, and rather they've had the challenge of PPP monies drying up and figuring out, okay, now what do we do? So I think for those businesses that are in that awfully difficult mode, one of the most important things a business can do, I think, is bring in a turnaround consultant who's focused on cost cutting and understands how to renegotiate leases if it's a retail business, or understands how to negotiate with lenders so that you have the opportunity to extend that runway as long as possible. And the art there is less about of course, you're protecting value, but the idea is how much can you cut in terms of cost and funding obligations so that you've got the greatest chance at coming out the other side. And so, and one reason I've gone into this is if businesses are in that mode that are project oriented, their customers have to believe that they're going to be in business when they get to the other side. Otherwise, they're not going to put in an order for something. It gets delivered in 6 months. So this whole perception, I know we use the word valuation, but I think the word viability is another awfully important element to look at. On the other side, for the businesses that have experienced demand being greater than supply, it's all about being able to handle the unexpected surge in demand. And I think that those businesses who've been nimble and responsive and also have created an environment where their customers, if you're dealing with the consumer, where the customers feel safe. And it's that combination that ultimately, I think, is going to lead an investor to put a premium on the business, because in the toughest of times, even if you are in a situation where you have opportunity, you've handled that opportunity in a way that everybody's benefited.
Mm-hmm. Thank you. Maybe, I'm trying to think, it's actually an interesting question that came in Q&A that we could address now. What overly creative adjustments that you've seen related to the impact of COVID, whether favorable or not, but to earnings or working capital. So have you seen anything creative, all of you, Richard, did you want to comment on
that? Sure. Actually, I'd like to do it in the context of just following up to Bruce, because this is an area that we have been very involved in because we do retail and consumer,
right? And
valuation is really something that we haven't spent any time talking about with our companies because, as Bruce said, they're literally in survival mode. And so some of the things, in addition to what Bruce already mentioned, that some of our companies have done, which I think, again, we're probably not alone in this, but, cash is king. So you did everything that you could to try to conserve as much cash as you could. We talked about taking down PPP money. We talked about ABL. But for the most part, retailers for sure were not looking at how much less they could pay certain vendors or landlords. They were deciding, who do I pay and who do I don't pay? And I'm going to lean towards not paying as many people as I possibly can until I can be reopened for business. And originally that was thought to be kind of a risky strategy, but essentially that's a strategy that just about every retailer took and has caused some lawsuits. And these are all getting negotiated out. Sometimes you're getting abatements. You're certainly getting deferrals on rent. Some of the other things that some companies have done when they were shut down, at least bricks and mortar wise, is that they accelerated their online business. And just to give you a statistic, I think pre-COVID, something like 18% of all, GDP transactions, however you look at them, were done online. And it had been growing about 1 to 2% a year. And in the 4 months of COVID, that number is now up to 28%. So we've essentially had 5 years of online business compressed into a 4-month period. And this has enabled some companies to do things like buy online, pick up in store, buy online, pick up at curb, which is called BOPAC. The other one's called BOPUS. And also to significantly improve their customer service levels, particularly online, to make the website as friendly as it could be in the store.
Great points. Gretchen and Mandeep, do you want to add anything to this topic?
Yeah, I'll jump in. This is Gretchen. Regarding the question, the creative adjustments in COVID, I would say it's too early. We're in COVID. It's too early. The only deals getting done, I say only based upon my review in the market of what's going on, are businesses that are relatively unaffected. So for those of us who are investing in, things that are not specific, like retailers, like Richard was talking about, we are still in COVID. And so to agree to an adjustment now without knowing, especially right now, the United States is in a far worse infection position today than we were when we shut everything down. I fully expect to see many states going back to phase 1, essential employed businesses open only, everybody else, work from home. And so I would say this is just Huron Capital perspective, it's too early for us to have agreed to or created or even thought about any creative COVID adjustments because we're far from being done.
Right.
Sorry to be a wet blanket.
No, I'm sure that in the future we'll see some creative COVID adjustments, and especially during our QOV. We are in the middle of several deals right now where we have to look at this COVID period, and I would have to add that everybody, buyers and sellers, are trying to figure this thing out, because just like Mandeep said, we're trying to predict the future, and who really knows? And as you said, Gretchen, we are still in the middle of the first wave. So,
Sylvie, have you seen any particularly creative approaches, given that you're seeing all kinds of different situations?
Not yet, and I'd say everybody has been fairly reasonable. So everything that we've seen so far is well expected. But I have to say that, overall, the business owners that are trying to sell their business during these past couple of months, they're very optimistic about the future, and they think that they can return their business to pre-COVID level and even continue to grow beyond that. So we, and we're going to talk about that in a minute, but we're really looking at, increased earnouts and more creative earnouts situations. And maybe, if, Mandeep, I don't know if you want to add anything to this topic, but we could actually go to the next slide and talk about deal structures.
Yeah, I just really quickly, I think I agree with Gretchen. Like, we're in the middle of COVID, so we haven't gotten to the other side to see what the true impact on businesses is going to be. But I do think we are at a point where people are actually thinking beyond COVID. Like, I think, March, April, even May, it was just panic. And now business owners, investors are thinking beyond. And I think everybody hit on topics that are true irrespective of whether we're in a pandemic or not. Those businesses that are attractive are those that are customer focused, resilient, adapt to changing environments and provide consistency. And so it's just become that much more evident in the current environment.
All right, thank you. Let's move on to the last slide, which is we touched on that a few times. But again, based on an open-ended question about the impact on deal structures, and really nothing surprising here is most of our independent sponsor respondents said that they would see an increased use of earnouts and seller financing. So, Richard, do you want to talk about this topic? And then we'll follow on with maybe Bruce and Gretchen.
Yeah, I think so. A lot of this has already been asked and answered. Mm-hmm. Because as you said, it's pretty obvious, but I think I'd like to make maybe one or 2 points about each of the specific aspects of this. So, with regard to seller financing and rollovers, equity investors, particularly in this environment, want the sellers to have more skin in the game for the most part. And so, two ways to do that are through seller financing, having them take back some seller paper, and rollovers. And, where rollovers may have been more voluntary in the past, I think, in this environment, rollovers may become a more permanent part of the deal structure. Mm-hmm. With regard to earnouts, certainly given the increase of uncertainty of performance, earnouts are probably the best way to share the risk between the buyer and the seller. And there will be, creative ways to do this, as I think Gretchen mentioned earlier. And then lastly, and a point that was already made, was the tighter credit market. So to the extent that lenders are increasing their underwriting standards and avoiding riskier investments, there aren't too many opportunities and too many options to go to other lenders, and the easiest one to go to would be go back to the seller and get some seller financing.
Right, makes sense. Bruce and Gretchen, Bruce, do you want to add anything?
Sure. I absolutely think that the concept of an earnout or a contingent note and the seller rollover, all of this stuff is going to play a more important or going to be more necessary to bridge the differences between buyer and seller. But, earnouts, for example, are fraught with complication under normal circumstances. And if we're getting into a concept of, let's say, the earnout is tied to adjusted EBITDA, and now we have a new definition of adjusted EBITDA that's complicated by COVID-related items, and they're less, there's a subjectivity, let's say. I can see, when you get to that point, an awful lot of potential friction in terms of that actually being something that gets executed constructively. Mm-hmm. And so one of the things that we've recently focused on as we consider the earnout option is to tie it to gross profit rather than EBITDA. Mm-hmm. So that, even if the new owner is burdening the business with various investments, so on and so forth, if you look at a combination of a dollar amount on gross profit and a minimum gross margin on that, then at least you have something that's less susceptible to disagreement. However, the other element of an earnout is being able to fund that earnout. So back to, well, what's your definition with your lender? as it relates to financial covenants and adjustments and building in an additional liquidity mechanism that enables you to fund that earnout. So I think what I'm really trying to say is I think conceptually we're going to see more creative approaches to structuring, but I think we're going to see more challenges in terms of realizing that added value down the road for the seller.
Thank you. Gretchen, do you want to add anything to this?
Yeah, two things to add. One, whether more earnouts get used or not, or seller financing, and Bruce is completely right. Those types of things are simply inviting a lawsuit or an argument years down the road. But given the current times, sometimes you have to do that. But it's a negotiation, and it really depends. That only happens if the seller really needs a liquidity event right now. If they don't, they will say no to that. And if they do, they will have to say yes to that. So I think it's really a, psychological or human need and, visceral or not reaction to it that drives the use of those. Another thing I am going to blatantly and shamelessly admit, this is self-promotion, but as I believe it was Richard who mentioned, there's a dearth of financing, there may be a reduction in what you can get from senior lenders nowadays. And so sometimes the only other place to look is the seller for some financing. Just like to remind the audience that we have a non-control equity fund, and we have seen an increase in requests into that fund, as we knew it would be as soon as the market went down for whatever reason. But deals that going into COVID had a senior lender in there that maybe was ready to lend up to 4 times, or maybe that plus maybe they were in at 3.5, and a mezz person was in and brought the total debt to 4.5. And then even though it's a COVID resistant deal, the bank says, or the lender says, you know what, we're not comfortable at 3.5, we're going to lend 2.5. So now there's a 1.0 times gap in the capital structure. That is what comprised the bulk of our inbound deal flow in March and April. Now we're starting to see businesses where the lender has asked for some pay down on the debt because the business is upside down, and they've waived covenants, but they said, we need you to bring some money in here. That's another reason where a non-control equity slug of capital could be helpful. So those are the only 2 points that I would add to Bruce and Richard and Mandeep's prior points.
I'm actually going to add something on some of the deals that we're looking at right now is so it's not just so there's earnouts, but there's also a working capital adjustment. So the earnout is obviously positive to the seller. It's extra proceeds. But there's actually a negative working capital adjustment because, again, the assumption is the business would return to pre-COVID levels. But that also means, higher revenue, higher EBITDA, but also higher working capital levels. So we have actually a positive earnout adjustment potentially, and then a negative working capital adjustment that goes the other way. So there's going to be some just interesting deal structures that are going to be put in place in the next couple of months. I wanted to, we have a couple of minutes left. We actually dealt with all of the questions except one, which, and I don't know if it's, it's relevant to your experience, but one of the attendees is asking if any of you have seen or you consider making any downward adjustment to earnout revenue targets for deals that closed in the month or two prior to COVID and then saw revenue recognition due to COVID. So again, for deals that closed before COVID, had an earnout, have you seen a reduction in those revenue targets? I'm just opening up to everybody. Have you seen it?
We didn't have any that meet those qualifications going in, so none for Huron.
Okay.
Yeah, nothing for me.
Okay.
Same.
Okay. So unfortunately, we don't have an answer on this one. So we are going to wrap up. And since we answered all of the questions, I have one final question for the panelists. And it's, do you believe that there will be any changes to valuations or deal structures that will outlast the pandemic? Gretchen, do you want to start?
Sure. Yes, I think valuations for I think most businesses are not COVID resistant. There's been some negative downward impact, and I think for those businesses, valuations will be lower for a period of years. Mm-hmm. I think the lenders, banks proper, will continue to be very, very buried and out of bandwidth, measuring the forgiveness amount for all the PPP loans. They haven't really even ramped up actually putting out money on the Main Street lending program, to my knowledge, except for like giant companies, even though it's called Main Street. So I think there will be some bandwidth issues at lenders for some time that will keep their leverage multiples low, but they'll still want to deploy capital. They have to as well. So I think that will last. I think that will be an overhang. And I truly don't believe that we're going to even be close to back to normal till sometime in 2022. So I think the valuations will continue to be low. And as such, I think these things that we're talking about, earnouts, seller financing, getting outside equity slugs, I think those will outlast as well. They'll chip away over the 10 years of the next recovery. Those things will all be chipped away at because of competition, just like we saw from 2008 to, February of 2020. But I think many of these changes, such as those that I mentioned, will indeed stay.
Mm-hmm. Thank you. Could not agree more. Mandeep?
I agree with Gretchen. I do think that the deal structuring that's going to happen in the next 12 to 18 months is going to be something that's going to become more normal than not, with heavy earnouts, true-ups, contingencies. It's going to be very interesting to watch buyers and sellers try to manage the risk and uncertainty that COVID created, while trying to balance what the true worth of somebody's business that they've built up is, and what that business is worth absent the COVID impact.
Thanks, Mandeep. Bruce?
Another element. I think that the underwriting process on the part of both the private equity groups and the lenders is going to have a long-lasting impact, both in terms of protecting against the risk of a recurring pandemic, but I think also looking at how management handled the business during the pandemic. So once we get, far enough away from what we are in right now, that's going to be an awfully important question as you assess, the leadership you're getting behind.
Bruce, that's a great point. And you've made me think of something that will change, and it will be, at least from, most of the buyers and investors that I know, whether you're a committed fund or an independent sponsor, we are going to be really trying to underwrite and assess the ability to pivot, the resiliency, and the ability to quickly move your workforce or whatever your sourcing strategies from where they are now to a different location. I heard a scientist speaking on COVID, and he said he believes this pandemic is an excellent dress rehearsal for coming weather-related events where maybe, a massive hurricane hits the Southeast or Texas, and widespread damage. And so relocation of your plant facilities, of your employees, et cetera, and your ability to quickly be adaptable to big events like this will very much be something we'll be trying to assess in management teams as we go forward. So thanks for prompt.
Yeah, all great points. And Richard?
Yeah, just a quick wrap up, really playing off of what Gretchen just said and also Bruce. So we are already starting with our companies. I think you're going to see them operating somewhat differently than they did before because they're going to have to. But things like scenario planning, greater emphasis on liquidity, and maintaining a crisis task force. Just about every company has established one. And, you're always going to have some crisis. And to plan for all those things that Gretchen mentioned, this role of a crisis task force is going to become very, very important. And I think some of those changes are going to be permanent in the way not just, lower middle market companies operate, but companies of all sizes.
Right. Could not agree more. So we are actually a little bit over time, but, I want to thank our panelists, Richard, Bruce, Mandeep, and Gretchen. Great job today. And, thanks for the time. Thanks for, the time you spent to prepare for this webcast. And I want to thank everybody for joining us. Stay tuned. Again, we have this special report on the impact of the pandemic on the independent sponsor sector that's going to come out in a couple of weeks. And stay safe, stay healthy, and have a great summer. Thank you.